Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Mark Williams to give his 3 stock picks. Mark is the manager of the Liontrust Asia Income Fund. Hello, Mark.
Hello.
So what's the first stock today?
The first stock today is a Chinese company called SITC, which is listed in Hong Kong, as all our Chinese investments are.
And what does it do?
They are a logistics company, and they are unique in that they have not only the overland last mile for delivering goods, but also the container services. So intra-Asia, amongst the larger Asia sphere, if you want to export from China or import into China from another country, you can use them all the way along the chain.
And for you, why is it a compelling investment?
It's a compelling investment because we still see Asia as a source of growth. And so what we're looking for is companies that pay out dividends, but will grow those over time at relatively good valuations. And SITC has the advantage in that the intra-Asian trade is doing fairly well. So whilst the rest of the world, we don't think it's a disaster, but it's not very exciting. We're not seeing huge growth coming from the US or huge growth coming from Europe. Within Asia, you've still got 6.5% coming from China, slightly less from some of the other countries, and they are dealing more with each other. And this is going to be the company that benefits from that part of the overall environment.
And what's the second stock pick?
The second stock pick would be a Korean company called LG Chemical.
And what does that do?
They are a petrochemical company. They are diversified in that they have both the feedstock for the petrochemicals, but all the way down to the end product, and also diversified horizontally in that they have a large number of end products from household goods down to more industrial factors. And it's also got a number of other arms, but one of them that's really interesting is the battery side of things. So as you're getting an increased use, either just through smaller electronic goods such as mobile phones, or more interestingly in things like cars, they should be a big beneficiary of that. And because that part of the business has been invested in and has only just started to approach profitability, you're almost investing in that for free at a time when the petrochemical side equally is doing very well with good margins there, which with an ongoing and again relatively low global growth seems likely to stay for a while.
Sounds like quite a product diversified company in terms of revenues. Is it globally diversified as well?
Yes, ultimately, particularly the petrochemicals, which at the moment is the majority of the earnings, as well as over 2/3 of the actual revenues, that is going to be subject to international markets and global growth.
And what about the third stock pick?
And the third stock pick that I'd choose today would be China State Construction International.
And what do they do?
They are a Chinese company, again, listed in Hong Kong, as all our Chinese exposure is at the moment. And they are going to be one of the beneficiaries of China's state spending on infrastructure. And whilst we want to see China's growth slow down, we think it's been growing too fast in an inefficient way, backed by debt in areas that you don't really want to see growth. We think there's a long-term potential for lots of relatively useful infrastructure spending to be made. And whilst the government would like to see, the Chinese government would like to see certain parts of the economy slow down, they equally want to continue growth in certain areas and are willing to back or continue to have public-private partnership investment in infrastructure projects. And China State Construction should be one of the beneficiaries of this.
Infrastructure spend in China was one of the things that drove commodity prices so high a few years ago. Of course, they've now come off because supposedly there was less demand for infrastructure in China. Is that sort of structural story turning around again?
I don't have a very firm view on commodities. I think the big commodity producers are likely to do well over the longer term. A lot of the commodity demand came from the housing market as well, and the Chinese government is very actively trying to stop or reduce a housing bubble if such a thing has actually appeared. So that side of it, they don't want the same sort of growth, the same sort of demand as they did do historically. And equally, at the time when you saw this commodities, everyone was talking about the mega cycle. That was a time of great global growth. And so, yes, China is growing, but it's growing about half the pace that it was in the run-up to that boom. And the infrastructure overall, though it's a positive, it's not the same scale as it was historically. So we'd rather go for the people where they're going to be a beneficiary of the actual infrastructure spending itself, rather than the secondary impact, which will be the commodity demand.
Mark, thank you very much.
It's a pleasure. Thank you.
This is Emma Wall from Morningstar. Thank you for watching.